Supermicro Computer is scheduled to report quarterly financial results on October 30th, although the date might not be certain. The company's been mired in controversy following a short seller report that suggested the company misstated its financial results. The company then delayed filing their official financial results, and the stock price has been in the penalty box ever since those allegations. In this video, I'll preview what investors can look out for when the company announces their quarterly financial results, and I'll highlight some of the figures that has investors concerned about Supermicro Computer stock and what it means for Supermicro Computer stock investors. This is not an easy company to evaluate because it's going through such unprecedented growth, and so I'll discuss those details in this video. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so in the fourth quarter of its fiscal year 2024, the company reported net sales of $5.3 billion compared to $2.18 billion in the same quarter last year. So more than double the increase in revenue in the latest quarter versus the same quarter last year. And this type of growth for a hardware company is difficult. It's difficult to manage this. It's not simple in just having your business more than double year over year. The logistics behind fulfilling that kind of increase in revenue is difficult to manage. Now, Supermicro Computer stock soared to start off the year in 2024. And if you remember, I had the stock rated as a buy in January, and then I told investors to take profits around the beginning of March. Not at the top of the price, but near the top of where the price was. Now the stock price has fallen from over $100 per share on a split adjusted basis down to roughly $47 per share as of this recording, and the bulk of the stock price decline coming after July. Now, I highlighted that there are some concerns from investors about Supermicro Computer stock. Revenue growth is not one of them. Revenue is surging on the back of the increasing demand for the hyperscalers to develop and upgrade their data centers, optimized for artificial intelligence, and Supermicro Computer solutions in this category, especially the liquid cooling solutions, are an excellent fit for what these companies are looking for. Still, the company does have competition from Dell and Hewlett-Packard and others, and so it's competing aggressively to gain market share, and that's causing its gross profit margin to decline, even though its revenue is surging. You don't often see that. So in the latest quarter, its gross margin came in at 11.2% compared to 17% in the same quarter of last year. So its gross profit margin fell by roughly 6 percentage points, even though its revenue more than doubled. That's rare. You don't see that very often. And that goes to highlight, and management has talked about how they're focusing on gaining market share. And even if that comes at the expense of lower margins initially, they want to get in, they want to get that market share, and then they can focus on getting profit margins or increasing profit later on by maybe selling services or add-on products to existing customers, or maybe when existing customers go to replace the Supermicro Computer technology that was installed here in 2024 and upgrade later on a couple of years later, Supermicro Computer can get better profit margins on the replacements and upgrades. Still, despite the lower profit margin, the earnings per share is rising because of how much revenue is increasing. Diluted net income per common share came in at $5.51 in the latest quarter, compared to $3.43 in the same quarter of last year. However, another area of concern is cash flow from operations, which was negative $635 million in the latest quarter. And that's another concern from investors because you're having this level of growth in a hardware business. As I mentioned, it's difficult to manage. One of the reasons is because Supermicro Computer has to pay for inventory up front, and then it gets money from its customers later on down the line. So when you're growing your business at over 100% and you're collecting cash flow from customers from last year or a few quarters ago, those cash flows are smaller in magnitude compared to the amount of money you're paying for inventory right now because your business has scaled up drastically. And so you have that mismatch between the cash outflow and the cash inflow, and that creates a big negative for Supermicro Computer. I'll share with you in the balance sheet how the company is adjusting to this, right? You've got to get this money from somewhere. Supermicro Computer sold some shares of stock and it borrowed over $1.5 billion to help support growth in the business. So management saying that they continue to experience record demand of new AI infrastructures, propelling 2024 revenue up 110% to $14.9 billion and earnings per share up 87% to $22 per share. Looking ahead for the first quarter that ends on September 30th, 2024, they're forecasting $6.5 billion in revenue at the midpoint, with earnings per share between $6 and $7.66, and continued growth over the rest of the year. For the full year in 2025, they're forecasting net sales of $28 billion at the midpoint, which would continue the company's excellent rates of increase. All right, so let's digest the balance sheet that's going through significant changes here as a result of the growth in the business. And the first area to focus on is inventories. From June 30th, 2023 to June 30th, 2024, the company's inventory has roughly tripled up to $4.4 billion from $1.445 billion. And I often discuss that when inventories increase, there has to be a second question that investors ask, and that question is the reason for the increase. Are inventories increasing because you have products that the market does not want? Or are inventories increasing because you're anticipating an increase in your customers' demand, and so you want to be ready for that by having the product on hand to deliver to your customers when they want it? And for Supermicro Computer's case, it's the second reason, the good reason. They anticipate huge growth in the business, and so they're getting ready for it by building up their inventories. Still, it causes concern from investors when you have this magnitude, a tripling of inventory at this scale, right? This is in the billions of dollars. So it is a little bit concerning for investors, especially now. It's even more concerning because of the reports of potential misreporting of financial statements and the company's lack of adequate response to those allegations. Okay, and then another thing that Supermicro Computer did to adjust to the current business conditions is borrow a lot of money. I highlighted that they borrowed over $1.5. Precisely, they borrowed $1.7 billion in convertible notes. And so they used that money to fund this growth. Otherwise, how would the company get that $3 billion in incremental inventory? They didn't have that much cash on hand to pay for that inventory, and suppliers may not be willing to give the company that much extra credit, right? They are used to dealing with Supermicro Computer and giving it a certain line of credit for inventory. But when Supermicro Computer goes back and asks for a tripling of that line of credit, they might hesitate to grant that increase. So one of the things they did is borrow $1.7 billion, and then they sold additional shares of common stock, and they raised an additional $2.3 billion here. You can see the common stock and additional paid-in capital rising from $538 million to $2.827 billion. So that's how the company is adjusting to this unprecedented change in business. And I've been arguing that if they have to go through all of this difficulty to fund this growth and experience the lower gross profit margins, negative cash flow from operations, maybe management, it might be more prudent to not try and gain that much market share, to maybe offer your product at a higher price to keep your gross profit margin at least level so that it's not decreasing year over year. And then your cash flow from operations won't be so negative. You won't need to go out and borrow money and sell more stock. And you can manage the growth of your business more effectively. it won't be so difficult. If your growth is, instead of 100% year-over-year growth in revenue, maybe that becomes 62% year-over-year growth in revenue, which is more manageable than 100%, right? From a management perspective, to operate the business, maybe it's more manageable that way. I'm not saying I have the answer. I'm just suggesting that maybe management might consider that going forward, given the difficulties they're facing. Now, Supermicro computer stock is no longer expensive if the numbers are indeed accurate. It's trading at a forward price to earnings of 10.64, which is back at the levels it was at in 2023, right? The reason I told investors to take profits in March was because the valuation had gotten to these astronomical levels, forward price to earnings of over 30, when the company is rarely traded at that valuation and the business did not justify this kind of valuation. Now the valuation has come back down to reality. It's no longer expensive. However, to answer the question, should you buy before earnings? I would say no, it's still too risky given the financial situation it's in. Just wait a couple of more days and buy the stock after the earnings. You're getting it at much lower risk after the earnings release. Sure, you might have to pay a higher price following the earnings release, but the lower risk will justify paying the higher price for Supermicro computer stock. Right now, the risks surrounding the company's financials are too high to tolerate given this valuation. So that's what I would suggest. Of course, I will have videos, multiple videos, evaluating the company's results once they announce their financials. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.